So imagine logging into your brokerage account one morning and you see a notification that one of your key holdings just vaporized almost $2 billion in a single quarter.
Oh, man. Yeah, the immediate instinct there is just to smash the panic button.
Yeah.
I mean, you see a number with 9 zeros in the loss column, and your brain instantly equates that with, catastrophic operational failure.
Right, totally natural reaction. You assume the underlying business model is just fundamentally broken, but then you open up the actual cash flow statement for that exact same period, and you see that their checking account is actually overflowing.
Yeah, they're generating more free cash than they did a year ago. It's wild.
It is. The engines are running leaner, they're running faster, even while the balance sheet looks like a complete disaster zone.
Which really creates one of the most fascinating optical illusions in modern corporate finance. The accounting reality and the operational reality are they're telling two completely different stories.
Okay, let's unpack this. Today we are looking at the Q3 2026 financial results of the North American telecommunications and media giant Cogeco.
And we definitely brought the receipts for this one.
Oh, yeah. We are pulling directly from their Q3 2026 earnings press release, their comprehensive management's discussion and analysis, the MD&A, and their investor presentation slides dated July 15th, 2026.
That combination of sources is so crucial here because, well, the press release gives us the shock value headlines, right? But the MD&A gives us the actual mechanical blueprints of how the business is functioning day to day.
Exactly. So our mission for this deep dive is to decode how a massive telecom operator manages this extreme tension between a staggering multi-billion-dollar paper loss and simultaneously surging free cash flow.
Right, we need to tear down the accounting jargon.
Yeah, and figure out what this actually means for the future of broadband and wireless. For you listening, whether you're an active retail investor analyzing your portfolio, a strategist, or, just a consumer wondering why the telecom landscape is shifting so fast, this is going to be incredibly revealing.
It really is a masterclass in learning to read past terrifying headline numbers. To see the actual machinery of a business. It forces you to ask, when the smoke clears on an earnings report, what is actually happening to the cash?
So let's start with the smoke. The most jarring figure from this Q3 report is a net loss for the period of $1.8 billion.
Yeah, huge number.
That translates to a loss of $42.84 per share. I mean, in a normal environment, a loss of that magnitude demands a serious explanation.
And the explanation lies in a mechanism called a non-cash pre-tax impairment charge.
Right.
Out of that massive loss, $2.2 billion was an impairment tied specifically to their American telecommunications segment. And on top of that, there was a smaller $25.6 million impairment in their radio media operations.
Wait, I actually want to pause on the radio operations for a second. The MD&A outlines the U.S. telecom issues pretty clearly, but what triggers a multi-million-dollar write-down in traditional radio in 2026?
Well, it's really the broader macroeconomic environment for traditional advertising. Local and regional radio relies heavily on, small to medium business ad spend.
Oh, sure.
So when economic conditions tighten or when those ad dollars migrate to digital platforms, the projected future revenue for those specific stations drops. And management is forced by accounting standards to recognize that reality today.
Okay, that helps make sense of the concept. So an impairment charge isn't like a check the company is physically writing to someone.
No, not at all.
It means management is looking at the assets on their balance sheet, the fiber networks, the brand equity, the broadcasting licenses, and admitting that, based on current market conditions, these assets just aren't going to generate as much future revenue as they originally modeled out.
Exactly. They're basically recalibrating expectations. Accounting rules dictate that if the present value of the future cash you expect to make from an asset drops below what you have it valued at on your books, well, you have to write down the value of that asset immediately.
So it's kind of like getting a new appraisal on a house you've owned for a decade. The appraiser comes in and tells you, hey, the market value just dropped by half because the neighborhood changed.
Right.
It looks terrible on your personal wealth statement, but if you aren't selling the house tomorrow and you just got a raise at your day job, your day-to-day wallet is actually thicker. The cash you have to spend hasn't gone down 1 cent.
That analogy gets right to the heart of the mechanics here. The asset is impaired, yeah, but the daily cash generation is totally insulated from that paper adjustment.
Right.
And if we look at Cogeco's actual cash generation for this quarter, The narrative flips entirely.
It really does. If you strip out those non-cash impairment charges and look at the adjusted profit attributable to owners, it actually increased to $29.9 million.
Which is pretty solid.
Yeah, that comes out to $3.10 per share, which is a really notable jump from $2.40 a share in the same quarter last year.
And even more revealing, I think, is the ultimate metric of corporate health, which is free cash flow. That figure jumped 15.7% year over year to $170.7 million.
So the business is generating significantly more cash than it was 12 months ago, despite writing down billions in asset value.
Yes.
But I guess that brings us to a really critical junction. To understand why that $2.2 billion write-down had to happen in the first place, we need to look at the geographical split of their operations.
We do.
Because if the underlying broadband technology is fundamentally the same on both sides of the border, why is the U.S. side forcing a massive impairment while the Canadian side is completely stable?
Well, we really have to look at the competitive intensity in each specific market. In their American segment, which operates primarily under the BreezeLine brand revenue, decreased by 10.1% in the third quarter.
Wow, 10%.
Yeah, it's a big hit. The MD&A outlines three intersecting headwinds causing this. You've got a lower overall subscriber base, a highly aggressive competitive pricing environment, and a major consumer shift toward internet-only services.
Right. Customers are just severing the cord completely. They're dropping the legacy TV packages, ditching the landline phones, and opting just to pay for the raw broadband pipe.
Exactly. And in the U.S. footprint, that migration is happening rapidly. It's drawing competitors into this vicious race to the bottom on standalone internet pricing.
But then you compare that to the Canadian telecommunications segment, and the sources show a picture of relative stability. Like revenue actually increased by a modest 0.5%, driven by high-speed internet additions.
Right.
And their adjusted EBITDA, so their operational profitability grew by 3.9% in constant currency.
And it is worth pausing on that term, constant currency, just because it appears constantly in these multinational earnings reports.
Yeah, good call.
It just means they are calculating their growth rates by stripping out the fluctuations in the exchange rate between the U.S. and Canadian dollars over the past year.
So it allows investors to see the true, raw operational performance without the noise of the Forex market distorting the math.
Exactly. So operationally, Canada is growing.
But I actually have to push back on something that permeates these financial reports.
Okay, what's that?
This internet-only trend in the U.S. is repeatedly framed as this severe negative pressure on revenue. But if customers are dropping video and TV packages, doesn't that massively reduce Cogeco's operating costs?
Oh, absolutely does.
Because paying for broadcast rights and live sports networks is notoriously expensive for telecom operators. Isn't shedding the TV package and becoming a pure-play internet provider actually a much leaner business model?
Well, what's fascinating here is that the cost-saving logic is entirely sound, and the data absolutely supports your deduction. Cogeco's overall operating expenses actually decreased by 6.0% this quarter, and the report specifically attributes those savings to reduced video service costs. They're spending less on programming because they literally have fewer TV subscribers.
Then why all the corporate anxiety over unbundling if their margins are technically being protected by those lower costs?
Because the nature of the customer relationship changes fundamentally when the bundle disappears. For decades, the telecom industry relied on the sticky video and phone bundle as their primary retention mechanism.
Right, the switching costs are just a nightmare.
Exactly. When a household has their internet, their TV programming, DVRs, home phone, all tied to one single provider, the switching costs are incredibly high. It is a logistical headache to change providers.
Yeah, returning cable boxes, porting phone numbers, waiting around for installation appointments. Consumers avoid that friction at all costs.
Right. But when a customer transitions to being internet only, all that friction just vanishes. They're infinitely easier to poach. They're no longer buying an integrated ecosystem, they're just buying a utility.
And when consumers view a product as a pure utility, they base their purchasing decisions almost entirely on who offers the fastest speed for the lowest promotional price.
Exactly. Loyalty evaporates. So Cogeco is forced to compete in these brutal pricing wars for standalone internet, which drives their top-line revenue down faster than the cost savings from dropping TV can make up for.
Wow. Okay. That is the structural shift causing the U.S. impairment. Facing this massive pressure to retain these newly unbundled, highly mobile internet customers, telecom operators can't just rely on legacy tactics anymore.
No, they can't.
They need a new retention mechanism. Basically, they need a new bundle.
Which leads us directly into Cogeco's ongoing 3-year transformation strategy. The presentation slides emphasize that they are currently executing the second year of this transition right now.
Right.
And a massive piece of this strategy is replacing that dying TV bundle with a new mobile wireless bundle.
Mobile connectivity is basically the modern equivalent of the sticky video package.
Exactly. And they are rolling this out aggressively. Cogeco Mobile launched in Canada in October 2025, and it already covers 99% of their footprint.
And down in the US, BreezeLane Mobile launched in 2024. But the mechanics of how they're executing this are really interesting to me because they aren't out there spending tens of billions of dollars to erect physical cell towers across North America.
Right. They're utilizing what is known as an MVNO model. That stands for Mobile Virtual Network Operator.
It's essentially like renting a fully furnished apartment instead of, buying land, pouring a foundation, and building a new house from the ground up.
Yeah, exactly.
They pay a wholesale rate to use an existing national carrier's towers. They rebrand the service as their own and immediately start selling it to their broadband customers.
Yep.
But doesn't relying on another company's infrastructure kind of cap their potential upside? I mean, they are beholden to the wholesale rates set by the tower owners.
Oh, it absolutely caps the profit margin they can achieve per wireless subscriber, especially when you compare it to a legacy carrier who owns their own network. Right.
However, strategically, it is the exact right move for their current situation. It's a capital-light model. It minimizes their immediate financial risk and capital expenditure, which allows them to offer a highly competitive mobile and internet bundle instantly.
Just to defend their broadband subscriber base?
Exactly. They secure the customer retention benefits of the bundle without taking on the multi-billion-dollar debt load required to build a physical network.
Okay, that makes sense. But the sources also reveal a pretty fascinating detail that shows management is playing a much longer game here. Because while they are renting the network right now via the MVNO model, Cogeco actually spent $588 million acquiring mid-band spectrum licenses in Canada.
Yeah, it was a huge move.
$500 million on spectrum. Why buy the invisible radio waves if you're just renting the physical towers?
Well, the MD&A refers to this as securing future optionality. It basically functions as a strategic hedge. They are utilizing the MVNO rental model right now to build a subscriber base and kind of test the market dynamics.
But by holding that mid-band spectrum, which, by the way, is critical for high-capacity 5G networks, they have the raw materials required to eventually build their own physical infrastructure.
Oh, I see.
Yeah, so if the MVNO wholesale rates become too restrictive down the line, or if they capture enough market share to justify the capex, they can transition from renters to owners.
It's like buying the empty lot next door, just in case you ever decide to build your own house.
Exactly.
And beyond the infrastructure side, they are also experimenting with entirely new ways to interact with consumers. The presentation details the launch of a sub-brand called Waylo, that's spelled with a lowercase w.
Yes.
It's a fully digital challenger brand they launched in Columbus, Ohio back in February 2026, and they've already expanded it across their Ohio footprint.
And Waylo is a direct tactical response to those American competitive pressures we discussed earlier. It is designed to capture a completely different market segment, specifically younger digital native consumers.
Right.
The whole premise is entirely self-service and app-based.
Yeah, you order the equipment online, you set it up yourself, and manage the account through an app without ever speaking to a call center representative.
Which strips out massive amounts of traditional customer service and installation overhead.
Yeah.
And that allows them to offer the aggressive pricing required to win internet-only customers without destroying their own profit margins.
But renting mobile networks, purchasing $500 million in spectrum, launching entirely new digital brands, integrating advanced AI analytics, all of this requires immense capital flexibility.
Oh, absolutely.
Which really begs the ultimate question for anyone looking at this company. Does Cogeco actually have the financial fortitude to pay for this massive strategic pivot while still keeping their shareholders satisfied? Especially in the shadow of that $1.8 billion paper loss.
Right. Well, if we connect this to the bigger picture, this is where that free cash flow metric we discussed at the start becomes the real hero of the narrative.
Let's look at the financial armor detailed in the MD&A.
So, despite all the competitive headwinds and the inherent costs of this transition, Cogeco boasts an adjusted EBITDA margin of 49.9%.
That is massive. That means almost 50 cents of every dollar they generate in revenue falls through as operating profit.
Yep.
In an infrastructure-heavy industry, maintaining a margin near 50% points to incredibly tight operational efficiency.
It does. It generates a really substantial pool of liquidity.
Mm-hmm.
And they manage their debt structure very conservatively to protect that liquidity. They have a stable debt profile with a 5.4% weighted average cost of debt, and a significant portion of those interest rates are fixed.
Okay, that's crucial.
Yeah, and they are currently sitting on $935 million in available liquidity.
Having fixed-rate debt in a transitional period like this acts as a massive shield. It means their interest payments aren't suddenly spiking due to macroeconomic shifts, leaving their operating profit intact. And because their debt is rated investment grade by agencies like S&P and Morningstar DBRS, they aren't struggling to access capital, which explains why they can afford to be so generous with their investors right now.
Right.
Because in the exact same report announcing the billion-dollar paper loss, the board declared a quarterly dividend of $0.987 per share.
Yeah, almost $1 a share,
That's a 7% increase year over year.
which translates to a dividend yield of roughly 6.2%.
Mm-hmm.
I mean, for income-focused investors, securing a yield above 6% from a company with investment-grade credit is a highly attractive proposition.
The optics are just so striking. The headline screams loss, but the board is actively raising the amount of cash they're handing directly to shareholders.
And they are doing it with a very wide margin of safety. The investor presentation highlights that their dividend payout ratio is a very prudent 30% of their free cash flow.
Let's break down the mechanics of that payout ratio for a second, because it really is the linchpin of their financial stability here.
Sure. So the payout ratio is simply the percentage of their generated free cash flow that they use to pay the dividend.
Right.
By keeping it at 30%, it means that out of all the raw cash they generate, after covering operating expenses and debt service, they only use less than a third of it to fund that generous 6.2% yield.
Leaving 70% of their free cash flow retained within the company's treasury.
Exactly. They're richly rewarding shareholders while preserving a massive reserve of cash to fund their own structural evolution.
And we can see exactly where that retained cash is going. They are funding heavy network expansions, like the 325,000 homes they've passed with new fiber-to-the-home technology since fiscal 2022.
Yeah, that's real physical growth.
They're physically expanding their high-speed footprint into subsidized, underserved areas and replacing legacy cable with pure fiber. They're funding the MVNO rollout. They're building the digital infrastructure for brands like Wello.
The math works because the underlying broadband asset, despite all the pricing pressures we talked about, is fundamentally just a cash-generating machine.
And this is exactly why reading past the press release is so crucial for you, the listener. If you only glance at the headline, you see a legacy telecom operator losing almost $2 billion.
Right.
But when you actually look at the mechanics of the business, the 50% operating margins, the fixed rate debt, the conservative payout ratios, you see a company generating a massive amount of cash, funding a major strategic pivot toward wireless, and paying you a 6% yield while you wait for the transition to complete.
The headline, net loss, is just an accounting mechanism adjusting for past expectations in a shifting U.S. market. The true heartbeat of the company is its free cash flow, its operational efficiency, and its ability to return capital while securing its own future.
So, to summarize the landscape here, Cogeco is navigating a deeply complex, structurally necessary transition. They are moving away from the highly profitable, legacy-bundled telecom model of TV and internet and fighting to rebuild that bundle as a modern, digital-first broadband and wireless provider. They're taking their lumps in a volatile U.S. market. They're maintaining steady growth in Canada and using their massive operating margins to fund a mobile-centric future.
It really is a classic study in managing legacy disruption. But analyzing this transition raises a much larger question about the future of this entire industry, something for you to consider beyond just this specific earnings report.
What should we be watching for next?
Well, as telecom companies increasingly shed their legacy video packages to rely purely on fiber broadband and rented mobile networks, they are basically betting their entire future on being the premier pipe into the home.
Right, the dumb pipe dilemma.
Exactly. But what happens when the physical nature of that pipe is disrupted? I mean, with the rapid expansion of low Earth orbit satellite internet constellations and the aggressive rollout of 5G fixed wireless access by the major cell carriers, the necessity of a physical fiber wire running at every single house is suddenly up for debate.
Oh, wow.
If alternative technologies can deliver comparable speeds right through the air, how do regional fiber operators maintain their pricing power in a market where the barrier to entry is literally falling from the sky?
It's a completely new front in the connectivity wars. Will digital challenger brands like Waylo and AI-driven customer service create a new kind of brand loyalty, or will broadband just become an invisible utility? We will leave you to ponder how the infrastructure of tomorrow might rewrite the balance sheets of today.
Definitely something to keep an eye on.
Thanks for joining us for this deep dive into the machinery behind the headlines. Make sure you follow the show for our daily earnings coverage, and we will catch you next time.